Thank you, and thank you for inviting me to give this presentation. So let me start by saying that obviously climate change and ESG topics are top of the agenda for regulators around the world. And I think the EBA is no different when it comes to that. We're working on a broad range of areas when it comes to updating the regulatory toolbox when it comes to ESG issues. Yeah. So if we go to the next slide, I would say you could say why. Why should we care? Is it really that bad? I think it's if I look at where people identify risks and have concerns, I think you'll see here latest from the World Economic Forum is one example, but there are many others. What's clear is that this is a big societal issue that's on the top of everybody's minds, right? So there's environmental concerns, but there's also broader societal concerns. And interestingly, they seem to trump pretty much everything except cyber risk at the moment, at least, right? So I think from that perspective, it's also appropriate that as banking regulators, one looks at, well, do we need to do something to address this risk and the future expectations in terms of these risks becoming more prevalent out there. So what are we working on? If we do the next slide. Yeah, so we're working across, I would say, the entire prudential regulatory framework. What does that mean? That means that we're working on disclosures, we're working on risk management, supervisory practices, macroeconomic, macroprudential tools, and we're also looking at how to evolve and update the core prudential regulation, namely capital adequacy requirements. We're in the process right now, and there's already been some work done to upgrade and evolve stress testing to cover and include climate change and other ESG concerns. We are in the process of upgrading supervisory reporting in a general sense in this area. And finally, we are also looking to, let's say, enhance, improve, introduce industry standards and labels, or at least nudging industry to start doing some of that. And that includes taxonomy points, stuff like green bonds, green securitizations. How do we label, if we are to label loans, mortgages in the retail segment? How do we go about getting that up and running to give some incentives and a nudge for banks and others to focus on financing the transition to a more sustainable economy, and that is the end goal. So let me take you through the areas one by one, and I'll start with, if you move down to the next slide, I'll start by saying. Covering pillar 3. So if we look at what has been going on in the disclosure world, that's where we've made the most progress, and that's been the first set of efforts, and they are more mature in the regulatory space. So first off, there'll soon be a set of technical standards that are going to be published on ESG risks and disclosures. They will be focused, I think, mostly on climate change related risks. And there will be quantitative information asks there, and then there will be more qualitative information asks on environmental, on a broader set of environmental, social, and governance related risks. So we are again covering the whole ESG spectrum, but with a little bit more being asked when it comes to climate change. Now, the climate change disclosures that we will be asking for will cover, I would say, transition as well as physical risks, and there will be they'll include a green asset ratio, and it will be asks about what mitigating actions are being taken when it comes to climate change risks. Now we've worked, I think, with other stakeholders, and I think we've been pretty open. So there's been a lot of public consultation on this. So I think we're pretty optimistic that this will help nudge and push through some change and some renewed focus on being able to actually disclose what's going on. And I think for banks, this is no doubt, it's ambitious, but it's also, I think, still doable. That is the sense we have at this stage. Now, I would say we would note that when you look at the new CRR3 proposal, which also includes supervisory reporting on ESG risks, that will no doubt help further push this agenda forward in terms of getting some information and disclosures to what banks have on their balance sheets. If we move on to the next slide, please. So here are examples of what will be asked. As you can see, it covers quite a broad range of topics, right? So there's something on asset quality, there's something on collateralized loans, there's something about how do banks' exposures fare when they look towards international agreed sustainability goals. There will be disclosures on physical risks. And that includes, I would say, by maturity, which I think is important here because this is obviously a longer run issue. And then there's a whole sort of green asset ratio and a broader sort of EU taxonomy point about, again, giving some key indicators that are easy to follow in terms of seeing what sits on banks' balance sheets. Then I think if we move on to the next slide, I'd like to maybe zoom in a little bit on the next element in the regulatory toolbox. This is risk management and supervisory practices. Now, we've already published a first report on expectations when it comes to bank risk management. You should expect more during 2022 on this. So more detail, more minimum standards. And the philosophical starting point here is that ESG developments are risk drivers of known risks. So they drive credit risk, they drive market risk, they drive operational risk, and also reputational risk. So here, the path forward is to have, I would say, more invasive regulation and more requirements and higher expectations being set for banks when it comes to how they manage risks and how ESG aspects are integrated into risk management. Now, I would say part of what's down the line will happen is that we will have the SREP process in Europe, which is supervisory reviews. We will also build into that over time ESG considerations, but that's sort of a next step after we've set out standards and expectations for banks, as well as for what supervisors do in terms of considering how well ESG aspects are integrated into risk management of the banks. Here I'd like to just draw people's attention to a recent publication by the SSM, which gives sort of an overview and a stock take on what the state of play is right now in the European banking industry. So this came out yesterday. So I think that's for those of you who are interested in this, let me suggest that you take a look. This will give you a sense of the direction of travel also when it comes to supervisory practices, where the SSM has been active as well. If we move on. So here are three aspects that I think we have been focusing on and that I think are important for consideration of bank risk management practices and approaches. So here, I think the overall message is that there is a need to be, proactive, focused on and being prepared for the ESG related challenges that are bound to be down the line. That includes, by the way, I think an expectation that one understands the policy measures that will be taken, or as regulatory measures that will be taken, how they will influence the bank's state of play. The three pillars in what we've been looking at, there's the bank's business strategy. And again, here I think there's an expectation that banks take the long view, and that taking the longer view, one sets out objectives, one sets out limits, that one is conscious of what one's clients and counterparts are doing. And I think that's the whole strategy aspect. And here, so that's the one pillar in the risk management considerations. The second pillar, this is basically integrating into the core of the risk appetite framework of banks. It means having them also in ICAP and ILAP considerations, so both capital and liquidity adequacy assessments by the banks. It means identifying data gaps and methodological challenges and overcoming them, right? Mitigating them, bridging the gaps, developing the policies inside the organization, and also having in place risk monitoring that matches what you've done in the risk appetite setup and also on the data side. So this is sort of core risk management. Then there's the whole governance aspect. Again, here, this is a tone from the top point. So this has to be part of standard fare inside the banks. That's the expectation. That means taking into account when you look at training, when you look at control functions, business lines, but also when you look at remuneration. So again, here I would say all three pillars are important. And at some level, what is being communicated here, and I think that should hopefully be clear, is that there is an expectation that it becomes not something on the side, but something fully integrated in the way the bank is risk managed. Implicitly, what's also being said here is that there is an expectation that it becomes part and parcel of the standard loan origination process in banks, which is it's understood that this is a significant ask, and this is a challenge for banks to do. That's also why it's being done gradually. If we move on. Now, finally, I think for the three pillars of the sort of the core prudential setup, the final pillar is sort of the core capital adequacy. Here we are in the process of producing a discussion paper that will be published in the spring, where we will be basically taking the view that yes, we will maintain a risk-based approach. We will also ask questions as to, well, if we are to evolve and update the current regulatory setup, what are the key areas where updates and changes might be warranted? And here I would say we are aware that there are both, let's say, green and environmentally harmful exposures on banks' balance sheet. So the question is, how does one identify, how does one address that in the regulatory framework? How should that be dealt with? But also I would say, what do we do when it comes to data and to challenges in terms of missing data? And if we are in a situation where it's difficult to quantify and measure the risks that we know are coming and know will materialize if we listen to the scientists, how do we get the longer run forward-looking approach built in to the regulatory framework on the prudential side? So here, I think the challenge is then obviously overall, how do we do a proper risk differentiation across the exposures on banks' books? That is the big element here. That ultimately this is what it boils down to. That's where rubber hits the road, if I can use that term. Now, so we're gonna seek input from stakeholders. There will be obviously some viewpoints and some suggestions and some thoughts laid out, but we will be initiating some consultation on this in the spring. So for those of you who are active in this space, I encourage you to stay tuned. I should also say that we're not the only ones working on this. You will notice that the UK authorities have put out some thoughts. There's stuff coming out from the Basel Committee as well. So there is a general push in this area. So this work will come, I think, to most major jurisdictions pretty soon. And I will say here the European Commission originally foresaw that this would have to be done by 2025. They've now asked that this be done, a first cut of this be done by 2023. So clearly the timelines are being moved forward. There's more ambition and more political focus on this today than there was just a couple of years ago. If we move on. So the next leg here in the regulatory toolbox is stress testing. And stress testing is part of, as part of the fabric. It's used to, I think, both make a risk assessment, but also to feed into the buffer assessment the assessed buffer needs for each banks, and hence they're part of the macroprudential setup in the regulatory frameworks. So what have we done so far, and what is planned sort of down the road? I say, first of all, I think we are looking, and we're looking ultimately to end up having regular stress testing, which includes climate risk elements. That's the end goal. What have we done so far? Well, for now we have done at the EBA a pilot exercise in good collaboration with roughly 30 large banks, where we looked at, well, what are the data challenges? What are the problems banks have in terms of actually being able to do this at the foundational level? So I think here it was pretty clear that how you divvy up the portfolio and which definitions you use and which taxonomy you use is key if you're to do a good stress test. That was the key insight. But also I think that there is still some work to be done, and the banks are, while hopefully being busy at that, they're still not there yet. So I think that was one of the core insights from the pilot exercise on climate risk. Now, there are other people out there in the regulatory world that are also doing stress testing based on climate. There are a number of European competent authorities that have been doing climate stress tests. And there's also right now, there's an exercise that's going to be run by the ECB/SSM in 2022. So these are all, I would say, preparatory exercises. They are pretty ambitious, but they are preparatory in that hopefully they will nudge forward industry as well as supervisors in terms of understanding what's needed on the data side, what's needed on the methodological side when it comes to stress test models. And certainly the hope is that there will be good constructive industry feedback on what works and what doesn't. Where's the realism good? Where's it less good on realism? So I think here there's more work to come. Now, I would say next up, which is also part of the challenge set that we face, we need to enrich and evolve the scenarios that we use for stress testing to include climate change related aspects and other elements in the ESG bucket. And I would say we need to find a way to look not just at the banking system, but also at the wider financial system to understand better the risk sharing that is taking place inside the financial system and society at large. Because obviously not all of the risks sit on bank balance sheets. So here there's a link to insurance, there's a link to financial markets, there's a link to what sits on households and corporations' own balance sheets in terms of risk. And finally, how much of the risk is actually borne by the future taxpayers or AKA the sovereigns, right? So here, again, a lot of work is being done to make this part of the standard stress test toolkit. It'll probably take some time, but we're busy in the lab on this one, yeah? If I move on, then I would say when it comes to labels and standards, so here again, I think there is an understanding that you need to have some language, you need to have some definitions out there, right? So I think here, I would say, hopefully, by introducing the requirement for supervisory reporting of exposures to ESG risks, that will create a natural dialogue between supervisors and banks. And that should hopefully lead to more investment and more effort, both in banks, but also by bank clients, to address some of the data gaps and data challenges that are faced today when it comes to understanding the importance of ESG risk drivers. We're also looking to do, let's say, analysis of and consideration on, is there a need for a dedicated framework for sustainable securitizations? So here again, there is a green bond initiative, but do we need a special framework to look at securitization and asset-backed products in financial markets? So here, I think we will. There's a report coming out, and following that report, we will see whether or not the European Commission thinks that there is a need for a dedicated sustainable securitization framework in the legal setup. But again, this is part of a labeling exercise, right? What is green? And I guess that it's important to say here that the trade-off we see and that's being debated is exactly, well, labels are supposed to help markets function better and help financial markets and investors, choose how you send investments and money towards more sustainable economic activity, and hence help finance the transition to a more sustainable economy. So that is the objective. Now, the question really is, do we need a dedicated framework for this, or is it better that is dictated by policymakers and regulators, or should industry itself rather develop and have a bit of trial and error as they find their feet in this? Now, the risk, of course, is as you have a bit of trial and error, will there be a sense that you can't trust the green label in financial markets, and hence accusations of greenwashing and whatnot? It could harm that desire for people to have some transparency so they can decide where to best send their money and their investments. So this is a trade-off: market development on the one hand, on the other hand, letting it having time for some trial and error. But then you have a greenwashing accusation hanging in the shadows. So there's a trade-off, and that we have to find a path here. And again, here there has been interaction with industry and stakeholder consultations, but let's see. There'll be a report put out where we express a view, and then we'll see whether or not the EU Commission takes this forward as a legislative proposal, or what happens. But this is again something that's in train. Finally, there is an ask. We've been asked by the Commission again to give an opinion on what can be done in terms of the green loans on the retail side. Again, here, how do we define them? How do you do it? What's the criteria? But again, a labeling exercise trying to give some clarity and maybe help investors choose as they move forward. So now I think I've covered pretty much the whole gamut of activities that we have ongoing. And as you can see, I wasn't exaggerating when I said that we are basically looking at the entire regulatory toolbox. So I think that I will stop here. Thank you very much.
Thank you very much, Jacob. Perhaps I have a couple of questions for you on your take how this ESG market will actually develop, because we recently had a couple of hiccups in the European asset management industry with sort of allegations that more assets are actually labeled as ESG than they actually are. So what do you think in terms of market perspective?
I think transparency is key. I think if you're investing in something, you should ask the tough questions of the ones who are trying to sell stuff to you. I mean, basic rule of investing. I know it sounds primitive, but I think that would be my first observation. Then I would also say that the moment you've said sustainable, my sense is that people then, depending on who they are, have very different perspectives on what is sustainable, right?
Yeah.
I'll give you two simple examples. One is that some will say to you, this is sustainable because I'm taking your money and I'm putting it into something that is funding a transition to a more sustainable economy. Then you would say, okay, but what about if there's collateral there, what is it? Then somebody might tell you, no, but the security I posted is really coal-powered power plants, So that's my security, but I'm using that to fund better stuff. So the focus is on where I put the money. Right? Others will say, no, to be super green, it needs to be both green assets and green purpose, right? To me, I would say, look, you have to make up your mind how green you want to be, right? I think it's totally legitimate to say, look, I'm going to put some old, soon-to-be obsolete assets in the box, use those as collateral for a short time to fund investments in something that'll make a difference. It could be putting solar panels on a house. It could be upgrading the insulation, right? There are many things you can do. I mean, a number of governments are providing support for that as well. But I think you need to look at what it is, what's in the box, what are you really buying, and then make up your mind. I wouldn't, at least at this juncture, I think that's what you should expect as an investor, that there's a little bit more effort in trying to understand when people say sustainable, what do they really mean, right? And I think that's the challenge. But I don't think there's no taxonomy that's going to make that go away. Yeah. Right? Need for basic due diligence, yeah.
Are you advocating then sort of a similar system like we have it with food, for example, that you have different degrees of how green ESG actually is, like ESG 1, ESG 2, and ESG 3, and everybody knows, though, what they're buying into?
That's certainly one possibility. I don't know. I'm going to be a little bit careful here, right? Because I think some will tell me that even the food labeling became quickly a little bit too complicated, right?
Yeah.
But in principle, yes. But you have to make sure that it's not too complicated either. But I would say also, what is green? I mean, my favorite example here, and I might be unpopular, but depending on where I sit, I'll say that nuclear power is very green, or I would sit somewhere else and I would say it's very ungreen, right? So you also have to make up your mind. What is it that you're seeking to invest in? And that, green mortgages, sure. What is green? Green cars, are electric cars truly green? I think this is still a live debate. So I would say, I think that's the key, no?
But the trend that ESG related or ESG investments are very much in favor currently or liked by investors, this trend will most likely prevail, right?
It seems so. I mean, it certainly seems so. I would say what's interesting from my perspective is that there's a growing supply of green bonds and green labeled investments. Most of them are probably green in one or the other form, right? And I think that's a positive, that there is an increased awareness that's showing up in the financial market. So that's not a bad thing. That will drive market development, and hopefully it'll drive some industry approaches to overcome this information problem, right?
Do you think that Europe is here perhaps at the forefront of that development because we have that climate pact and a lot of focus on like greening the economy, especially now in response to the COVID crisis, or are we at par with other regions in the world?
I think Europe is doing well. Net would be my take. I think there's an ambitious political agenda being rolled out. I think again I would be a little bit. I don't want to make it digital, right? Because there are dimensions in which we're doing less well and other dimensions in where we're clearly in front. So I think it's a bit mixed, but I think overall, I think Europe is leaning in here, if I can use that old phrase, no?
Yeah. Perhaps one question on risks associated to that big shift into green, into the green agenda, because you're also assessing risks. So what do you see as the main risk or challenges in that process?
So one of my areas of concern when it comes to green and climate change is that I think we need to have a look at our mortgage markets and our real estate markets and be careful that we get it right when it comes to the value of the collateral. And I also think we need to have a more careful look at how the risk sharing is actually working, right? A lot of households, companies actually insure their properties. But the question really is, do we have the risk capacity if we are going to see an increase in flooding risks and we're going to see some demands on the collateral base, if you will? How do I value that? I think if we don't get that right and we don't start investing and considering more carefully the climate change aspect when it comes to collateral valuation in our mortgage and real estate financing system, I think that would be unfortunate. And I know people are talking about it, but I think this is a critical area. It's a very important part of the of the financial activity space, right? That would be one area. The second area is I think we need to be very, I think, mindful of the fact that as we do hopefully change the economic machine, if I can use that phrase, there will be industries and there'll be sectors where there'll be obsolete capital, where you might have the need to have on top-up investments or transformation investments. And I think it would be unfortunate if in our process to try and get this right, that we make it impossible to do these transformational investments of existing assets. I don't think we can afford to as a society. That would be my other, in terms of when I'm a regulator, what am I afraid of breaking, so to speak, right? If I can use that term. So those are my two sort of main, in terms of risks I see. The last one is probably more for me and my cohort of regulators, but I still think it's an area to be focused on.
Well, thank you so much for all this information and your insight, Jacob.
Pleasure.